In this video, we'll take a look at what a candlestick is, popular candlestick patterns, and potential limitations of trading with candlesticks. Candlestick charts are useful when trading because they provide more information than a simple bar chart. Traders can use the candlesticks and the patterns that they create to forecast short-term moves in the price. So, what does the candle represent? A candle represents information for a specific time period. For example, on a daily chart, a candle represents a day. On an hourly chart, it represents an hour. A candlestick shows four elements. These are the open of the time period, the high, the low, and the close of the time period. The wide part of the candlestick, also known as the real body, represents the price between the open and the close of that time frame's trading. The colour is important. A black filled-in candle means that the close was lower than the open. Meanwhile, if the real body is white, then the open price was higher than the close. Sometimes red is used instead of black and green instead of white. Above and below the real body is the shadow, or the wick, which represents the high and the low traded that day. For example, a short upper shadow on a down candle means that the price closed near the high. So why do traders use candlesticks? Candlesticks portray a lot of information for each trading period in a very visual format which is simple to interpret. Traders often use the ups and downs of candlesticks to try to find a pattern within the movement and forecast what could happen next to the price. There are lots of patterns, so here we'll go through a few for you to then practice in order to incorporate into your own trading. The Doji. A doji has no or almost no range between its open and its close. This candle reflects indecision in the market. Neither the bears or the bulls are in control. The dragonfly or gravestone doji suggests that, respectively, sellers or buyers control the market for most of the period before the opposite group managed to push the price back to the open ahead of the close. A bearish engulfing pattern is seen in an uptrend when sellers then outnumber buyers. This is reflected in a candlestick pattern by a long red candle engulfing a small green real body. This candle pattern suggests that sellers are back in control and the price could continue to fall lower. A bullish engulfing pattern occurs when buyers dominate over sellers, so you would see a long green body candle engulfing a small red real body. The price could be expected to move higher after a bullish engulfing candle. The hammer is a candlestick which has a small body and a long wick below the body. When a hammer appears at the bottom of a downward trend, it suggests that sellers tried to push the price lower, but these efforts were overshadowed by buyers who pushed the price back higher. This could indicate the exhaustion of a trend and the potential of a bullish reversal. The reversal is confirmed should the next candle rise above the neckline of the candle before the hammer. The hanging man candle is identical in shape to the hammer. However, this one occurs in an uptrend. This pattern suggests that the uptrend is approaching exhaustion. Bears are emerging and could push the price lower. Again, confirmation is needed for the reversal. The next candle should fall below the neckline of the candlestick prior to the hanging man. The shooting star is the inversion of the hanging man. It has a small body and a long wick to the upside. It happens at the top of an uptrend and suggests that there is resistance to push the price higher, and a bearish reversal could be on the cards. Confirmation of the reversal happens when the price falls to the open of the candle prior to the shooting star. With these candlesticks, it's worth keeping in mind that the longer the duration of the candlestick, the more powerful its effect will be on the overarching trend. In other words, a hammer seen on a 1-hour chart will have almost no impact on a 6-month trend. However, a hammer formed on a weekly candle, its reversal would be more significant. It's also important to realise that just because there is a shooting star with confirmation, for example, there is no guarantee that the price will then start falling or how far. It may also quickly reverse higher again. Candlesticks are often best used with other trading tools and strategies. Here we've looked at the properties of a candlestick and what it tells you. We've also looked at some simple but effective candlestick patterns. And these are just a few of the many candlestick patterns out there. It can be more useful to learn a few to fully understand how to use them and incorporate them into your trading strategy, rather than coming way down and overwhelmed by many patterns which you can't remember properly.